You've had a few weeks now to evaluate the tax bill. This is where I'm going to start. How it affects your business, how it affects the competitive environment. What conclusions have you drawn?
Well, relative to the place of American business in the world, our competitiveness has improved. I don't think we've gotten any competitive advantage, but I think we've caught up to the rest of the world. I think it was entirely an appropriate and good thing to do to make American businesses competitive with the businesses of other developed markets.
Does it change the competitive environment for your industry?
Well, it has a lot of benefits for our industry. Our industry was a very, very relatively high tax-paying industry, and now we've converged with other countries. You know, they did a good job of widening out the base, removing deductions, and having a kind of a rate that will be a common rate for everybody. They've equalized the consequences of versus keeping money overseas versus bringing it home. I think it's actually made the system more sensible. So to that extent, we like operating in a sensible system.
Do you agree with the idea, if you will, that at least among banks, the savings from the tax cut will be, quote unquote, competed away?
Competing away, and how do you mean?
Competed away. Pricing. You know, you have the ability to price, or there's the opportunity to price things more aggressively, your margins shrink, and then you don't realize as much of the bottom line as you might have otherwise.
Well, who knows? There's a market, and so people will, things will get to a point where price is clear. I don't think necessarily, you're right, I don't think necessarily margins, people will invest more, but that's the intention of it. Some people will return capital. One of the things you hear constantly is, oh my goodness, people won't invest in their business, they'll return the capital either in the form of dividends or in the form of stock buybacks. I never quite understood that because it amounts to the same thing. If I can't invest in my business at a return that's accretive to the return I have, I'll return it to my shareholders, and what do they do with it? They don't burn it in a bonfire. Then maybe they'll go out and they'll invest in a company that they'll think is a higher return. Ultimately, it's the shareholders' money. The shareholders will decide where to invest it, but it gets invested, and that reinvestment's good for the country. U.S.
banks, the firms in your industry, and Goldman included, were well-capitalized, profitable, and competitive before the tax cut.
Right.
Will this force changes elsewhere? And what I have in mind is if the European banks, for example, want to remain competitive with the U.S. banks that now have an advantage, what are they going to have to do?
Well, first of all, our tax rate has always been high. There was a bit of a catch-up element. And secondly, the predicate of your question, we were profitable. The banks were profitable, but the criticism by investors of most U.S. banks is most banks in the United States didn't earn their cost of capital.
For a while, that's true.
Well, it depends what you think the cost of capital is, but people have thrown around for a long time that number of 10%. Our ROE was, adjusting for the change in the tax law, was about 10.8%. J.P. Morgan was around the same amount, but very few of the other banks make a double-digit return. So you could say that the banks were profitable, but nobody thought they had an excess of return. Most of the banks in the U.S. banking system had a return that was the opposite of excessive and didn't necessarily catch up to the cost of capital. I think this will be helpful, and a healthy banking system, again, is the predicate for a healthy industry.
So peak ROEs so far in this cycle, to your point, at least with American banks, have been about 13, roundabout.
It's a long. I'm trying to remember 13.
What do you think it's going to be now that you have the tax cut behind you?
Well, I'd say
if you look, at the way you think things are going to evolve with the economic backdrop.
I don't think ROEs for most of the large SIFI banks in the United States have been 13%.
No, not most. I think J.P. Morgan might have hit 13 at one point.
Well, at one point we hit 13 and we hit 30, but I'm saying it's been not since the financial crisis have we seen that. We haven't seen that number anywhere for that. I think it's been rare. Not rare. It's rare institutions. We have consistently been above 10%, but just above 10%. I don't think any of the banks have killed it in terms of returns since the financial crisis. Not necessarily a function that the business is so bad, but banks have been required to hold a lot of capital, and that's what's reduced returns. So you can argue, and some people might like that outcome, because to the extent that you have a lot of capital, you're safer or sounder, but you have to be careful to make sure that the returns get over what people think of as the minimum return they need to invest in your institution, or else you won't have banks.
So with tax reform, with economic growth, with a slightly more normalized interest rate environment, with perhaps a little bit of deregulation on the way, what might ROEs look like over the next couple of years?
Higher.
Yes, but by how much?
As much as we can make it.
Is there a theoretical limit on where you think it can be, given, again, the regulatory constraints that you're operating under?
Higher. We work, we work against an opportunity set. So it depends where you are in a cycle. Higher than they are now. I don't think, look, I don't
You're not going back to 30?
No, we're not, because we're not, no one will have that leverage. We wouldn't have that leverage.
What about 15?
Highly possible.
That's
highly
good.
possible. But, you're asking me, I can't, we won't even agree on the past. We're not going to agree on the future.
Lloyd, you've been peppered by many already with questions about Goldman's fixed income business, which, for those who aren't familiar, had a tough year and the toughest fourth quarter since the financial crisis. Here are a few more. What's the problem?
Well, I'm not, this has been a poor part of the cycle for the fixed income business. People can quibble whether how much of this is cycle and how much is a permanent change. We wouldn't extrapolate if it was the most feverish part of the market and extrapolate from that. And we're not going to extrapolate what the opportunity set is in fixed income at a period of time when you have an absolutely flat yield curve, no volatility, and almost virtually zero interest rates around the world. I don't think this is the best opportunity set. Having said that, we probably underperformed a bit even within the opportunity set that we have. So part of the question, I think of it in two parts.
That's implicit in the question, I think.
Well, the two parts is the strategic one is how much are you investing in fixed income opportunity, and secondly, how well did you execute it? I think we could have executed better as far as our investment in the opportunity. I think we have an appropriate investment. It's been reduced. The market has helped us reduce the opportunity. It's something under than 20% of our revenue, which is something that we always tried to achieve, and the market wanted us to reduce it. But frankly, we reduced it by really, really, really driving growth in our other businesses. We had record years almost across the board in our other segments. And in fact, notwithstanding a very difficult opportunity set and a difficult year in what historically has been the business we're identified with, we actually increased our revenue over it. We so outperformed in all the other segments that we even compensated for a weak fixed income quarter. And I don't think necessarily that it stays that way. Again, some people, I have to, look, we get accountable for running the business throughout the cycles. And at any given moment, we're getting a lot of advice to do. We take it all into account. But our FIC business and our commodity business is a jewel. But let's face it, if oil is going to stay within plus or minus a few dollars from the same price all year, it's not necessarily going to be the golden age of commodity trading.
Execution is a factor. Strategy is a factor. Talent's a factor, too.
Yep.
Do you have the right people running the business? Does it need a management change?
We have the right people running the business.
And throughout the business, do you have the right people in place?
We have 35,000 people. Here or there, we may have somebody where we could find somebody better. But I would say people have said a lot of things about Goldman Sachs. I've never heard that we lack for talent.
Okay, that's fair. You've explained some of the weakness in FIC by saying Goldman is indexed to a certain market. What do you mean by that?
Well, I'm not sure how I used that before, but I'm saying there's a certain kind of opportunity set.
But does that have to do with your clients, the kinds of clients you have?
Sometimes clients, but listen, if the price of oil stays the same or energy stays the same, how much are you going to spend to hedge your energy risk? If you think that tomorrow you're going to wake up and the price is going to be the same, the next day it's going to less. So at a time of low volatility, it's not just that the margins for the business that you do are smaller. People do less business.
But other firms face similar opportunity sets, if not the same ones, and on a relative basis.
No, this year there was
done
also,
better.
I said there was an execution we could beat, but over a cycle, we've tended to do pretty well over a cycle. The fact is, we underperformed the opportunity set, but not by much. Nobody did very well. And I will tell you, the time to make if you have to, you should judge over a cycle where we've done well. But if I wanted to pick a single point to judge, it wouldn't be the worst moment or the best moment. So it's very hard. You know, when the tide is rising, everybody looks great. When the tide is fallen, everybody looks poor. We've done pretty well over the cycle.
This is true.
And by the way, with the same crowd that are running the business today.
Wall Street, as you know, is equally fascinated and terrified by automation. How much promise does automation really hold for a firm like Goldman?
Oh, terrifically. Once upon, I walked one of our alumni through the fixed income floor, and in his memory, there was a lot of noise and screaming back and forth. You could hear a pin
telephones
drop.
on each ear.
But it's not just the way that people are communicating prices. The prices are being made electronically and effectively algorithmically and distributed that way. It's tremendous. But let me tell you.
Tremendous means what, though?
Tremendous means less likely to make errors.
Than humans.
Less expensive to run. They may displace a certain number of humans, but the importance of very good humans at the fulcrum of that lever become even more important. And the definition of who's making, once upon a time, the trader was sitting there exercising intuition. Now you have that intuition built into an algorithm, and somebody's making that algorithm. In some cases, it's the software designer, it's the programmer that really is kind of what the trader has been becoming, because they're anticipating all the impulses that would go into the information, and they're designing it into the system. And so things are moving around. But at the end of the day, you still need judgment, you still need an exercise, you still need a relationship, and you still need to communicate. Some of it's done digitally. It used to be done by phone, but the basic core of what we do still needs to be done, and we're still doing it.
Which businesses at the moment offer the most promise in automation? Which are the priorities for you?
Well, anything that's volume intensive still goes. And I'll tell you one other thing. One of the initiatives that we're, aside from all the technology that we're performing on our existing businesses, technology has opened up kind of new horizons for us. So Goldman Sachs has always been associated with wholesale businesses.
Mm-hmm. Now you have your consumer bank.
But the technology has allowed us to get into a consumer business, because the consumer experience is only an element of that business. What's an important element of that business is digital distribution, algorithmic risk management, distribution. And because of that, it's sometimes making a credit decision for 5 people wasn't in our wheelhouse. Making a credit decision for 5 million people absolutely is.
Makes sense. A question for you about crypto. I know you love this topic.
Is Superman's planet, or?
Every investment bank appears to be building a business, a cryptocurrency trading desk, if you will. Where do you stand with that?
Well, we have announced, and I tell you, I get showered with these questions.
I know.
It's so easy. There are futures contracts. We clear futures for our clients. For our clients that want to trade futures on Bitcoin, for which there's a contract, we said we would clear that. But with trading, principling, making market, we're not doing.
How much demand is there from clients for futures clearing at the moment in Bitcoin?
Not a lot.
Not a lot. Does that surprise you?
No.
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 Do you think it'll ever be a lot?
It might. Again, there's a lot of things under heaven and earth that I thought would go one way and they went the other way. And so I'm not, look, I don't think it will take, a store of value that moves, 25% in a day, goes down by half in a week. A transactional medium that's so hard to do, and where a high percentage of it gets lost or forgotten or stolen. It's not agree. But if it does work, I'll be able to explain why it did. Really. And I meant that. In other words, I could think of reasons why it would work, but it doesn't rise to the level that from those reasons I predict that it would.